there are some surprising advantages to trading futures, and that's what we're going to be talking about in this video. We're also going to be talking about a trade that I took, and I'm going to show you how you can apply some of those advantages and be able to still make big money while trading small, for example, trading micro futures. So let's go ahead and get into it. So futures are a leveraged instrument, meaning they are worth several times more than whatever the underlying is. So for example, the Emini it moves 50 times the amount that the S&P 500 does. And the micro Emini moves 5 times. So the micro and the regular Emini provide different kinds of leverage depending on your capital and how much you're willing to risk. So the E-mini moves 50 times what the S&P 500 does. So you can see on the right, if the S&P 500 moves $1, then that means that our position size, or the value of our position, would not go up $1. It would go up by $50. So, or if we were short the E-mini, for every $1 change in the S&P 500, that would equal a $50 change on the E-mini. So let me go ahead and show you how this can be an advantage for you. Let's assume you have a $100,000 account. All right, and a common idea in the market is that the S&P 500 will go up on average 8% a year. So right now the market's at 5,800, and on average it'll go up 8%. All right, so that'll come out to 6,264. So on average, the S&P 500 will go up $464 1 year from now. Now that's an average. There's obviously a huge amount of variance that could happen. If we could go down 2,000 this year, we could go up 2,000. We just don't know. But on average, historically, 8% is the metric that we're looking at. So if you had $100,000, if your account was $100,000, and we can look at that math, that's pretty simple. 100,000 times 1.08, and that'll give you 108,000. So on average, with a $100,000 account, if you put it all into the S&P 500, on average, after 20 years of doing an average, you would make on average $8,000 from that. Okay, so every year, on average, you would expect to make $8,000 by buying the S&P 500. Now, let's say instead you buy the E-mini. Okay, so we're gonna do one E-mini contract. Now, we know S&P 500 on average will go up $464, like we see here. So 464 times the leveraged E-mini, which is by 50. All right, let's see what that is. All right, so that is 23,200. So we can see that there's a huge difference here compared to making 8,000 just by buying the S&P 500. If you buy one E-mini contract, it's leveraged. So you're going to end up making 23,200. So instead of making 8% a year, you're going to be making 23% a year. Okay. Now, to earn this 23%, you also would have to have that downside risk. So, let's say the E-mini instead goes down $464. Well, then you would lose that. Your position would be down 23,200. But on average, your position would be up by the 23,000. So, leverage gives you advantages on the upside, and it increases your risk on the downside. But on average, if we're just looking at averages over, let's say over 20 years, on average of buying the S&P 500, it would be up 8,000. But buying the E-mini we'd be up 23,000. So it's the difference between a 23% return and an 8% return. So not only would your expected return be higher, but you'd also have tax advantages. So if you are futures have several tax advantages. For one, the futures capital gains rate is lower than other forms of tax rates. So futures is always taxed at the long-term rate. Well, it has a split. 60% of your gains are taxed as the long-term, and 40% are taxed at the short-term. And the long-term rate, for most people, it's going to be 15%. So you have that advantage there where 60% of your taxes are taxed at this lower 15% rate. And some people that only exclusively trade futures, they don't do anything else. They don't have any other business or work. Then all of their taxes are just at 15% or less than that. And so futures has a great tax advantage by doing that. Another advantage is your cost. So if you're buying one E-mini contract, that costs $5. So for $5, you can gain this large increase in your expected return. Now, a contract ends every 3 months, so you'd have to buy 4 contracts in a year. So that'd be $20. So for $20, you can essentially go from 8% to 23% if you're willing to have that downside risk of those years, or 2 or 3 years in a row where the market might be down. But once again, on average, for $20 a year, you could earn 23% compared to 8%. If one E-mini is too much for you, then there are the micros, and a micro is 1/10 the size of a E-mini contract. So let's say I can't trade a full E-mini, but I'd be willing to do a half of an E-mini. So that would equal 5 micros. So 5 micros, on average, you could expect to make 11.5% per year. So this is still beating the expected value of 8%. And you're also having less, instead of trading the full E-mini, then you're just trading half. So you're getting, so your total risk is less, but also, your total expected profit would be less. But 11.5%, that's still beating the market over the long term. So if you'd be able to, with a 100,000 account, if you'd be able to have 5 micros, then on the long term, you would outperform the S&P 500, which everyone says it's impossible over the long term. Yet, here's the math right here that you can do it. So I want to show you one way that I take advantage of futures, and that's by trading micros. And so you can trade micros just like the way you trade anything else, right? You can do intraday trades, you can do scalping, swing trading. In this example that I have, I'm showing the trade here. I shorted here, and I was expecting us to have several weeks, at least several days, possibly several weeks of downside movement. And so because of that, I shorted here, and I held until this morning, and then I got out this morning. So looking at some of the technical reasons why I took this trade was, to me, this biggest point was the FOMC. So we have this big bearish day from that Wednesday, and when the FOMC is being more hawkish, when they're leaning towards higher interest rates, or when they're leaning towards the lowering of interest rates to be slower, then the market doesn't like that, and the market fell more than 200 points that day because of that. When something like that happens, you usually get more selling over the next few days to few weeks. And that's what we've gotten here. And we might have more down. But the reason I took profit here, we were coming up close to the 200 moving average, which is going to act as support. And then if you look directly to the left, we also have these prior lows here and here. So we have support from these lows here, and then a confluence of support with this 200 moving average. And the 200 moving average, especially on the daily chart, and this is the daily chart, especially on the daily chart, the 200 moving average starts to become very strong. And it's even stronger on a weekly chart. And in fact, a lot of the crashes that happen, you can go back and look, a lot of the crashes end at the 200 week moving average. So as you go up in time frame, these moving averages get stronger and stronger. So I shorted here with a 1 micro and then got out down here, and that netted $710. And what did it cost me to take that trade? It cost me $1. I think my commission, I think it's about $1.15 or so for a micro. So for $1, I was able to take this trade and get a profit of $710. So, I mean, the big picture is that the market has a bias towards the upside. So every year on average, like we said, has an 8% expected return. Now, some years might be down. Some years might be up a lot more than 8%. But on average, it's going to be up 8%. So in general, taking these counter trend trades like this, like going short and holding for several days, in general, you should probably avoid doing that on a longer time frame, because you will slowly be beaten by that tendency for the market to go up. It has a slight bias every day to be a little bit higher than it was before. So I would really hold the shorts for these more specific and specific trades like this, where the FOMC had bad news and the market probably would have a little bit more down. So I was comfortable taking that and holding it for a few days or a few weeks. In general, if you're trying to trade the micro and hold for several days and do something like I've been talking about, then I would try to stay long instead. And it's probably even better if the market has maybe a 20% pullback or a 30% pullback. We've had a very strong run over the last, 15 years. I mean, the market's been basically straight up for the last 15 years, and in the last 4, it's basically been straight up. So, at some point we will have a deeper pullback, maybe almost certainly below 5,000, and probably below 4,500 or 4,000. We'll probably get to that in the future. So if it does get to that price, I know I'll be considering just taking a position in the micros and just holding that as long. So instead of actually holding the S&P 500, I would prefer to hold the minis and hold long that way. I could see that as being a better return than just straight up holding the S&P 500 like ETF, for example. So I'll just that's kind of one tool you can kind of have in the back of your pocket. And also just for trading in general, this shows that you can trade relatively small with these micros and still make a decent profit. This is just with 1 micro, and the effort was pretty low to make $710, right? I just put the short on. I knew we have our targets down here and support levels down here. So after this 200-point day, the market will probably try to get lower. If you've been watching, I've been talking about this measure move here for a bit now, and it's reasonable that we'll get here. I'd rather just get out here at this higher point, though, with all the support we have right here. So yeah, micros, there's lots of opportunities on the micros for holding for several days. like any of these pullbacks, right? You can consider buying at the moving average, or finding some way to get long and then holding for several days or several weeks or several months. And I think look around, and I think there's lots of opportunities for people with small accounts to still make a decent return just by trading the micros. A lot of the times people will ask me, they'll say, I want to learn how to trade. This is what I've been interested in that for a while, and I want to learn it. I want to trade, but I have a 9 to 5, and I'm not able to actually sit down in front of the market and trade. So, what can I do? Well, I think this kind of swing trading where you're holding for multiple days, I think this is a great way to trade. Trading is fractal, which means that it's the same across all time frames and across all charts. So trading the daily chart, it's going to be no different from trading the 1 minute chart. Trading the 30-second chart on gold, in theory, is no different from trading the daily chart on Apple. The market, there are two parties, there are buyers and sellers, and that is based on human psychology and emotion, and that's going to present itself in general the same way across all charts and markets. So I think trying to take trades similar to this, where you're pretty confident that there's going to be more down, then take the trade and hold it for several days or several weeks. And if you're on the right side of it, then you'll find that, well, hey, I just made a lot of money, and it was in addition to my regular work. This is money that I really didn't have to do anything for. I just had to understand what the market was doing and choose the direction correctly. So in theory, you never even have to day trade. You can just trade maybe the hourly chart, the 4-hour chart, the daily chart. I mean, there's lots of entries through here. The market's up. You could just look at pullbacks to the moving average. There's so many through here. I can just, choose this one. Pull back to the moving average. You get out, basically get out up here at the highs. That's how, so you'd be getting out right here with 2 times your risk. So, market's going up. So you want to be looking to take buys. You're buying on a pullback to the moving average. And if you did that, that would have been 140 points in about 2 weeks. And so in theory, you can just trade the daily chart and practice that way. And then as you get more confident and understand the charts better, then you could just increase your size. And then that's all you have to do. You just trade the daily chart. You take a trade a week on the daily chart or something like that. And, then that's how you could trade. So you could be making that money alongside of whatever your career is. And then over time, you can increase your size to the point where that would replace your career. So you don't have to day trade. You can, there's other options, there's different routes that you can take. And, I think trading like this, trading the micros or the minis and holding for several days, I think that'll help. I think that'll help a lot of people. And I think more people should consider doing it. So, guys, I hope that was insightful. I make these videos to try to give you guys information and do what I can to help you out, because I know it's tough. Everyone that does this, they're going to struggle. So, whatever I can do to kind of remove some of that pain for you guys, and I want to do that. So, thank you guys for watching. I do hope this was helpful, and I'd be happy to make more videos like this. Just let me know in the comments what you're interested in, and I could make something like that. All right, I'll see you guys next time.